Good morning to all. In this video, we're going to see about the first topic of security analysis and portfolio management, that is investment avenues. See, investment avenues, before going to investment review, let us understand the concept of investment. Investment is an asset or an acquired with a goal of generating an income or an appreciation. See, it's a common individual or a expertise a finance person. Whoever wants to invest a money on a certain thing, after a certain period, they expect a raise in the form of capital or an interest or some other form of increasing in the value of particular asset. So that to be treated as an investment. For example, if I invest money in a monetary asset, for ideal asset which is in the future, if I sold the particular asset should be have higher value. Like example, I am buying a piece of land for around 20 lakhs. After 5 years or 10 years, if I am going to sell the same land, I may get at least a 1 crore for the same land. It is profitable. So whenever an investment is needed, you should see that in the future the value of the particular asset has to be increased. That is the way you have to make an investment. Basically, there are 5 fundamentals when you are making an investment. First one is start early. Even there is a saying that when you wanted to stay investment, do it today. Same way, whenever you are making an investment, as a fundamental thing, you should know that you should start early. For example, if you are going for an investment like insurance or any other investments, if you go started at the early, the premium rate will also be little lesser compared to going for an age at the age of 40 or 50. So early starting any investment will give you more benefit in form of financial as well as longevity. Then investment regularly. See, there is a habit of culture in India is that we always say, earlier we used to say that we have an investment economy or savings economy. But today after 1992, slowly the country is changing tremendously. The investment economy is also changing. But there are people who wanted to success in their investment. You should understand that you should invest regularly. For example, if you wanted to invest from your salary, regularly you should invest monthly at 2,000 or 1,000 for a particular investment. So these type of regular investments will give you more interest as well as more earnings when you compare to irregular meaning of investment. The next topic is ensure the higher return of investment. See, assuming that there are 3 types of investment, suppose A, B, C. For example, A has return on 3%, B have return of 7%, and C have return of 9%. See, out of that, normally we ensure that we expect an investor to have a higher return. So, whenever you are making investment, your investment should have a higher return compared to the normal return to the certain assets. Then never time the market. If you take any investment as individual investor or any large type of FDI or FII, they never cannot predict the market. What is going to be happen in the future? If you say that for a particular example, if a company is listed in NSE or BSE, if the stock price is very high today, even the company is performing very good in fundamentally, if there is any future, in near future, if there is something goes wrong in that company, the market trend of the particular script will completely change. For example, I can quote it out. There is one company called as Satyam Computers. In the year of 2012, the company has been actually one of the top giant in the IT sector. There was some issues with the Meta's company, which has been a sister concern of a particular CEO, where they are given a contract. Out of that, the company has shown the business profit. It has raised a big issue. Because of that particular script has been listed in the market, has got very affected, and the price of the particular scripts are got down. So never, as an individual, you can't even predict what is going to happen in the particular company in the future. The next one is be patient. See, normally there is a saying that in invest in a stock market, it's to be a gamble. No. Even if today there are people are making profit in a stock market or any investment, if you take about, only thing is you should be patient enough to wait till the particular scheme is getting up. I'll give you an example. I have one of my friend invested his money around 10,000 in the year 2020. It's 24, right? In stock market. Do you believe that the amount which invested in a particular script, today the cost of the particular script is holding for a 3 years, the amount is now it's 37,000. Only thing is you understand the patience of holding a particular script for a longer period. So if you took any investment and holding for a longer period, you are being patient, so that automatically your returns on the investment will be much higher compared to the short term investment. And if you are not being patient enough to have consciousness on your investment, it will not be good for you when you make any investment. Then next topic is characteristics of investment. There are basically three characteristics in the investment. One is whenever an investor who wanted to seek an investment, first thing is you look for a return, a profitability. See, I am supposed to invest a money of rupees 1 lakh in a particular investment. What I look for, I always look for the return of for the amount. Same way, if any investment I am going to invest, the primary or a basic objective of any investor would be investing his money at the maximum priority based upon the return. The second objectives are expected to be depends upon the nature of investment, maturity period and market demand. See, in the nature of investment, there are certain investments which are risk free and certain investment are termed as highly risk securities, highly risk investment. For example, when you invest your money in bank, that is said to be risk free investment, where RBI and your central government and your state government have given a backup to that particular investment. So you will be having a large amount of safety in that particular investment. Whereas when you invest your money in a share market or debenture market, there the investment return will be higher, whereas the investment type is like risk is also too much high compared to the bank investment. You go for an FD or an RD. Same way, the next investment is maturity period. Depends upon the maturity period also you may choose an investment. Like when you investing your money for a SIP, that is systematic investment plan in a mutual fund, it will be like login period will be 3 years or 5 years. Whereas in you are investing your money for a share market, you can even invest today and even in the morning and evening you can withdraw your money for intraday. So based upon your maturity period of the investment, the return would be depends upon. Then market demand. Sometimes there are certain investment on a certain period which will be very high in nature. The people would be tended to invest more on their particular sector, so the demand for the particular investment would be much higher. The second one is risk. See, you always understand the concept. Whenever a term called as return, it is correlated with a term called as risk. See, the term how much amount you are getting a return, the same amount of money you are also getting on risk. See, if you are investing your money, if you are getting a 10% return on a particular investment, that is, there is also risk involved as 10% when I do the same return. Then expected return depends upon based on the loss of capital, then non-payment of interest and variability of return. So these are the aspects when we are considered to make an investment, how much risk involved in the particular securities or particular investment avenues. Then characteristics of investment is also there are certain things we have to consider, like equity high risk investment, debenture or bond low risk investment, which I told you. Banks is also low risk, whereas low return. So you compare the three different types of investment. Whereas equity, that is share market, we are investing, the return will be higher. Whereas in your debenture and bond market, the risk will be lower, return is also high. Whereas in bank, it is a low risk and low return. And the next one is safety. Safety is an important aspect when you make an investment. As an investor, you always look for your safety. See, assuming that if I have 1 lakh or 5 lakh, whatever the amount, if the amount which I am going to invest for a particular period, the particular time, the investment will be with the particular time period for with the amount where they invested. So I should understand that my investment has to be safety. After a certain period, I have to withdraw or I have to sell it. So depending upon the return of capital or loss of the money at the time, the safety aspect is also considered more important. Suppose even the bank has low risk, low return, the elderly people prefer to invest their money in the bank. The reason is because of safety. Even there are people who invest their money in government bonds and securities. There is a reason also called as safety, because normally these investment doesn't have a high risk, but is have a good safety because the government is fully backing up the investments. Then liquidity. Liquidity is nothing but converting of cash. When you making an investment, after a certain period, if you are able to convert that investment into a cash, that is called as good investment. If you not able to convert your investment, see, if nobody is there after 5 years, you are nobody there to buy your investment, or if nobody is there to look for the opportunity which you are going to sell, particular investment, it cannot be sold, so it cannot be easily liquidated, it cannot be easily converted into cash. So those types of investment cannot be considered when you are making investment. So whenever you are making investment, you should consider that it should be easily converted into cash. Hedge against inflation. This is the last topic. Hedge against inflation is like, normally you used to say about inflation. Inflation is nothing but change of money value over the period of time, or we can say like too much of money chasing very few goods. Assuming that if I buy a car with a certain amount of in the years of 1980s, 70s, with the same amount, if I could buy a same car today, no. The value of money is dramatically changed, right? So that is inflation rate. Say every year there will be an inflation rate declared by the RBI. So your investment has to be higher than the inflation rate. Suppose today the inflation rate is 8%, assuming that. Then your return has to be at least 9%, 10% for your investment. Then it should be treated as a good investment. If not, that investment is not valid, because your inflation rate will always weaken your money, so that you will not be gaining profit out of it. Thank you. We will see you in the next topic on the video. Thank you all.